Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Plug Power stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, 2.2 billion market cap. They're trading at $3 a share and they have 750 million shares outstanding. Plug Power develops hydrogen and fuel cell product solutions in North America, Europe, Asia, and other countries in the world. The company offers GenDrive, a hydrogen-fueled proton exchange membrane fuel cell system that provides power electric vehicles. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So every year it's negative free cash flow. They're not really generating much revenue, so they haven't hit break even yet. 2023 was their worst year, negative 1.8 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative each year, and it seems to be getting worse. Negative 1.5 billion in the trailing 12 months. Revenue is a sales for the company, and that can't be negative. That peaked in 2023 at almost 900 million. It's come down to 800 million in the trailing 12 months. Revenue per share is 106. Share price is 292. Price of sales is share price over revenue per share. So 3/1, so it's about a 3, which is a pretty good price of sales. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 6 billion. We discounted those numbers back to today using the weighted average cost of capital. Their WACC is 11%. And we get a value of the company of $3 billion. We divide that by 750 million shares. And we get a calculated stock price of $4. They're trading at $3, so they're trading at a 26% discount. It is a buy according to the model, but it's a tough one because they only have negative free cash flow in the past. I assumed they would have a pretty steady growth up through 2027. Then they would finally be profitable. That's a lot of assumptions, of course. So it's a risky stock, but greater risk equals greater reward. There are 26 companies in the same industry as Plug, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They actually spend the most in CapEx out of all these companies. That's why they have such a big negative free cash flow. They have a good debt to equity ratio. For every dollar of equity, they have 30 cents of debt. I thought it'd be a lot worse. By far, they have the worst free cash flow, negative 1.6 billion. Most companies are positive in this industry. You could have positive free cash flow if you're not looking to grow and scale. What they're doing is sacrificing cash flow in the early years for greater growth potential in future years. Only time will tell if it pays off. They rank 14th in market cap. It looks like it should be 11th. They have the best price to book, so they have a good balance sheet. I guess that's something. Generally, the lower the better for these ratios. Price to book is stock price over book value per share, or market cap over equity. Equity is on the balance sheet. It's assets minus liabilities. It's a value of the company according to your balance sheet. We can't look at their PE. They have negative earnings. You can't have a negative PE. We can't look at their price to free cash flow. It's negative. You can't have a negative price to free cash flow. Price of sales can never be negative. It could be 0. It can't be negative. Price of sales is a lot better than the average. They're trading at 2.7 times revenue. I showed you earlier their stock price is about 3 times their revenue per share. It's actually 2.7 times. And they're growing the most. Their 5-year annual revenue growth rate is 36%. If you put $10,000 into this company 10 years ago, you might have been the only person to do that. But if you did do that, you would have been at $150,000, maybe $160,000 after 7 years. But then you might have jumped off a bridge because you would have been down 30% if you held on to it the full 10 years. Down 28% overall. Let's go through their 10Q. This is their income statement, the first quarter of 2023 versus the first quarter of 2024. Revenue is actually half. It was 210 million last year, and now it's 120 million. That's definitely not a good sign. I like to understand how a company generates revenue. And they give some detail right here on the income statement. A little more than half their revenue, 68 million, is from the sale of equipment, related infrastructure, and other. That's down about 70% from last year. 13 million in services performed on fuel cell systems. That's higher than last year. 18 million on power purchase agreements, 18 million on fuel delivered to customers and related equipment. Those two are up a lot. And then 2.4 million of other. So the only thing down is sale of equipment, which is really important because you need to sell the equipment in order to service it. Let's see if they give a further breakdown of the revenue. Here's a different breakdown. Of the 120 million, 19 million is a sale of fuel cell systems, 12 million is a sale of hydrogen infrastructure, 1.4 million of electrolyzers. That was 40 million last year. You don't have to be an expert on what they sell, but it's good to have a high-level understanding. That's really my goal. Eventually, I may become an expert, but for now, I just want to understand the basics. Electrolysis is a process of using electricity to split water into hydrogen and oxygen. And that all takes place in a unit known as an electrolyzer. So electrolyzers are critical technology for producing low-emission hydrogen from renewable or nuclear electricity. Electrolysis from hydrogen production has been growing a lot in the past few years. Sale of engineered equipment is also down a lot. Sales of cryogenic equipment was 57 million, now it's 31 million. Here's a breakdown by country. 106 million in North America. Look at Europe, it went from 40 million to 8.5 million. Asia is up, 3 million to 5 million. Other went from 5 million to under 1 million. I like this chart. It gives us their revenue, cost of revenue, gross profit, and gross margin by line item. The sale of equipment generated 68 million of revenue, but it cost them 135 million. So that's a negative 98% margin. Every dollar they generated in revenue, they lost a dollar. Usually you want to make money, not lose money. Services is break even. Power purchase agreements, 18 million of revenue, cost of revenue 55 million, negative 200% margin. Fuel delivered to customers, negative 220% margin. Last year they made money on the sale of equipment. Revenue 180 million, cost of revenue 160 million, so they had a 13% gross margin. Their cost of revenue was almost identical when you compare this year to last year. That's pretty interesting. I think that's a coincidence. Let's see if they explain why their revenue went down so much. Revenue from the sale of equipment went down the most in dollar terms, not percent terms. And they give a little more detail on what the product revenue is. It's revenue from the sales of equipment of our GenDrive units, GenSure stationary backup power units, cryogenic stationary and road storage, hydrogen liquefaction systems, electrolyzers and hydrogen fueling infrastructure. Revenue from electrolyzers decreased 39 million due to a decrease in 1 megawatt electrolyzer stack sales during 1Q 2024. The decrease in hydrogen infrastructure revenue was due to 3 hydrogen site installations compared to 14 last year. Revenue from cryogenic storage equipment and liquefiers decreased 25 million. That was due to a slower rate of progress on existing projects as they near completion. The decrease in revenue related to fuel cell systems of 10 million was due to the mix of class types sold during 1Q 2024. So they just tell us they're selling less. But I wonder if there's a real reason. Were the customers not happy? Are they having trouble getting new customers? Are they having manufacturing problems? Revenue from power purchase agreements went from 55 million to 18 million. Let's see what they say about that. Revenue from power purchase agreements is payments received from customers for power generated through the provision of equipment and service. There were 32,000 GenDrive units under PPA arrangements, compared to last year of 28,000. Let's go back to the income statement. Below revenue is cost of revenue, 279 million, so they have a gross loss of 159 million. Last year was 69 million. Operating expenses of 100 million, that's down from 140 million. Their biggest expense is SG&A, 78 million. Let's see what they say about SG&A. This includes compensation, so payroll, benefits, amortization of intangible assets, and related costs and support of our general corporate functions, including management, finance and accounting, human resources, selling and marketing, IT and legal services. So it's a lot of payroll. SG&A decreased 26 million or 25% from last year. The decrease was due to a decrease in stock compensation of 30 million. A lot of companies pay stock-based compensation. It's a way to subsidize employee pay. So their operating loss is $259 million, worse than last year of $210 million. That gives them a net loss of $300 million compared to $200 million last year. And they're adding shares. They had $589 million last year, now they have $641 million. They're going to need to keep diluting shareholders or take on debt just to fund their day-to-day operations. Let's look at a statement of cash flows. The first section is operating cash flow. That's how much cash the company lost from running their business. In the first quarter of 2023, they lost $277 million of cash. This most recent quarter, they lost $168 million of cash. The way to calculate that is you take your net loss of $300 million, then you add back the non-cash items on the income statement. It looks like they passed to a loss of $40 million on obsolete inventory. That's a non-cash item, so they add it back here. They had a cash inflow of $96 million from accounts receivables. This means they sold product on credit in the past, and now they're receiving the money in the first quarter of 2024. So I guess that's the big difference between last quarter and this quarter, accounts receivables. Actually also inventory. Last year they had a cash outflow of $130 million of inventory. Now it's only $38 million. So they're buying a lot of inventory, but they're not selling that much. They actually bought so much inventory, they had to write down $40 million because it was obsolete. So there was some mismanagement on the purchase of inventory. Let's look at the investing section. This is when a company buys or sells their CapEx. Also acquisitions are here. They spent $92 million of CapEx. Last year was a lot more, $168 million. Here's a breakdown of the CapEx. Construction in progress, $850 million. That's their most. Construction in progress is construction work that's not completed. And CIP is not depreciated until that asset is placed into service. They give a little more detail down here. CIP is mainly construction of 3 hydrogen production plants. Completed assets are moved to their respective asset classes, and depreciation begins when an asset is ready for its intended use. Interest on outstanding debt is capitalized during periods of capital asset construction and amortized over the useful lives of the related assets. So they took on debt to fund this CIP, or at least to fund part of it, and the interest on that debt is also capitalized while they're constructing the asset. Then when the asset is constructed and completed, then they'll start depreciating it. The second biggest in this category is hydrogen production plants, $350 million. So what are hydrogen production plants? The way it works is hydrogen fuel combines with oxygen from the air through a fuel cell, creating electricity and water. Software, machinery, and equipment, $240 million. So total is $1.5 billion. They depreciated $96 million. Land is never depreciated. CIP is not depreciated. So they depreciated these 3 items. Let's go back to the statement of cash flows. The way they get money to fund all the expenses is in the financing section. It looks like they sold some equity in the open market and received $300 million. Let's see if they give a little more info on that. Here they talk about it, public and private offerings of equity and debt. It looks like B. Riley is the investment bank that helped them sell this stock. In February of this year, they sold $700 million of stock in an at-the-market offering. They amended the ATM, increased it to $1 billion. They sold 79 million shares at a price of $389 for proceeds of $300 million and expenses of $3.9 million. So it looks like they wanted to sell $1 billion, but I don't think they sold the entire amount. Maybe they're going to do it in stages. It looks like they issued $5.2 million of secured debt, 7% convertible senior notes. So that means the holder of the debt can convert that debt to equity if the stock price hits a certain point. Let's go back to the statement of cash flows. Cash at the beginning of the period, $1.17 billion. At the end of the period, pretty much the same. You can find these numbers on the balance sheet, $1.168 billion. Let's search that number. You won't see that number on the balance sheet, but if you sum 3 numbers, it will equal the 1,168,084. So if you sum up the $173 million of cash, the $219 million of restricted cash, and the other $775 million of restricted cash, that equals 1,168,084. So this is the statement of cash flows, 1,168,084, and that's how you connect the statement of cash flows to the balance sheet. And here's the balance sheet. You just sum up this number, and this number, and you get that 1, 168,084. Let's look at a company on Simply Wall Street. Its last price to 72.1 billion market cap, down 7% in the past week. Look at this, down 75% in the past year. In the past 5 years, the stock had a low of $2, a high of 73. So it's getting pretty close to the low. There was a lot of hype on this stock in 2021. All those gains faded away. Will they come back? I'm not too sure. Simply Wall Street does not value the stock. 24 analysts have a price target of $4.79. They say it's 78% undervalued. Their revenue forecast for this year is $900 million, next year $1.4 billion, then $1.9 billion. But the free cash flow forecast is negative this year, next year, and the year after. They were debt-free in 2013 and 14, then they added some debt in 2015, added a lot more in 2019 and 20. Now they have $546 million of debt. But their equity is always a lot higher than their debt, which is good. And their cash was really high in 2021, but it looks like they used most of their cash. It's down to $170 million currently. The CEO's salary went from $600,000 to $750,000. Total compensation $7 million. Tenure as CEO 16 years. In the past year, there's been no insider buying, one sell. Half the company is owned by the general public, 41% by institutions, and 7% by private companies. Their biggest shareholder is Vanguard at 7.4%. The second biggest is Grove Energy, never heard of them, 7%. Then BlackRock, State Street, Morgan Stanley, 2.26%, UBS, 0.6%. Voya, the SF investment manager, Schwab, 0.5%. Swedbank, the Swedish company. Amundi, the French company. Jane Street, the New York City company. They are adding a lot of employees. It was under 200 in 2013, only 600 in 2019. Now it's 3,900. So that does imply there's some demand if they're adding employees. The ticker trades on the Nasdaq, Deutsche Börse, Zeta, London Stock Exchange, Wiener Börse, Euro TLX, Mexican Bolsa, and the Bulgaria Stock Exchange. So let me know what you think. Give the video a like, subscribe, or comment below if you'd like to get a custom evaluation.